Private equity and venture capital sectors have undoubtedly been impacted by the sharp rise in inflationary outlook and interest rate hikes of the last 2 years, and the resulting challenges to the funding environment and primary capital markets. However, whilst there is clearly pockets of exuberance and unsustainable valuations in some areas of private equity, following a period of what was extraordinary returns and significant capital raising in the prior period, we believe many areas of the private equity sector are indiscriminately being viewed through a single lens of negativity by many market commentators. Private investments, by their very nature, bring a number of complications to traditional portfolios, given the underlying illiquidity, valuation uncertainty, and higher cost burden. However, as we have discussed in previous episodes of this series, companies are choosing to stay private for longer, and capital managed by institutions is being allocated to private assets at a far faster rate than that of publicly listed investments. This is a powerful and important trend, and therefore we explore the sector again with a discussion with the chairman of one of the clear success stories of the London-listed private equity investment company sector, the HgCapital Trust. Welcome to the Investor Insights podcast, hosted by Killik Co. My name is Gordon Smith, and in each episode, I'll be interviewing portfolio managers from across the investment industry to gain from their expertise in the specialist areas in which they invest, and to question them on topical issues. You can access the full series of interviews via the playlist on the Killik Co YouTube channel, or by searching for Killik Co's Investor Insights on Spotify, where you can subscribe and be notified of future episodes. We hope you're enjoying the discussion so far, and you can get in contact with us about any of the topics discussed via the email address investorinsights@killik.com. Killik Co is an independently owned wealth manager which opened its first office in 1989 and provides services to help families save, plan, and invest. And you can find more details on the unique ways in which we do that at our website, killik.com. In this episode, we were joined by Jim Strang, who was appointed to the HgCapital Trust board in 2018 and became chairman in 2020. Jim has extensive and varied experience within the private equity industry, as well as serving on the board of several private companies. He was notably appointed regional chairman and managing director at Hamilton Lane, the sizeable Nasdaq-listed private equity advisory firm where he was a member of the Global Investment Committee. Earlier in his career, he was a strategy consultant at Bain Co within their private equity group, supporting numerous PE managers. The HgCapital Trust, ticker HGT, is a $2.4 billion market cap London-listed investment company which provides listed equity investors with exposure to a diversified portfolio of private equity investments managed by HG, the London-headquartered private equity investor with over $70 billion of funds under management, and which specialises in software and services companies in Europe and North America. We discussed a number of the merits of using the listed investment company structure as a way of gaining exposure to private assets, providing market liquidity for shareholders, but an evergreen fixed pool of capital for the investment manager back in episode 26 of the Investor Insights series, ahead of a discussion with Martin Davis at Molten Ventures. The attractions are mirrored in HGT, albeit focusing in a different subsector within private markets. HGT's specific focus, which we discuss in the interview, and the company's consistent track record of realising assets at or above the carrying value, a feature which has continued to be evidenced through the first half of this year, with the company selling around £400 million worth of assets at an average price 13% above holding value, goes a large way to explain the shares trading on a narrower share price discount to NAV than most of the rest of the listed private equity sector. The London-listed trust is the largest single client of HG, which has been managing the trust's assets since 1994. The strategy offers exposure to a diversified portfolio of HG investments, but without the long-term lock-up or high minimum investment requirements common of a typical private equity fund. as well as the additional layer of governance provided by the independent board, which Jim chairs. The trust invests across 3 pools of capital, often termed Mercury, Genesis, and Saturn, and you'll hear Jim reference these in relation to specific holdings in the discussion. These pools relate to the differing sizes of investee companies. Whilst HG's strategy is focused on mid-market deals, a term meaning investing in established and profitable companies rather than earlier stage private equity or venture capital, the different pools refer to smaller mid-market deals in the case of Mercury, right through to investments with a deal equity in excess of €1 billion in the case of Saturn. As always, please do get in contact using the podcast email address if you'd like any further explanation or detail on any of the terminology or topics discussed in this episode. Hi, Jim. Good morning. Thank you so much for sparing some time. How are you doing today?
Good for a Monday morning. I can't complain. Thank you very much.
Early on a Monday. Thank you for that. So, Jim, our kind of standard first question is attempts to get a bit of an insight into you, really. And what we've been asking is for maybe a kind of explanation of a kind of typical working week, or maybe just an anecdote from a recent meeting that you've had, or an interesting article or book, anything that you could kind of share that what you've been working on recently.
Well, I've had a really interesting. I'm just back from Stanford University, where I went to AI school for a bit.
Oh, wow.
And that was very, very interesting. So, because obviously HG is a portfolio of software assets, and so obviously we're very aware of the risks around and the opportunities around AI. And I decided I didn't know enough about it, so I took myself off there and sat in that melting pot for a bit and tried to figure it all out, which was really, really useful. So and actually quite heartening, and to the extent that I went away. Because my natural bias is to be a bit worried, and I actually came back much more enthusiastic about the opportunity. So that was very cool. It was very nice to be able to.
Yeah, souned great. Yeah, so how long were you out there for?
It was a week off dawn till dusk. So basically they blast it out in 7 days.
Yeah.
And they bring together. They've got a bunch of people that have obviously at the university, but then they bring entrepreneurs and CEOs in as well, who actually are in the space. So you got a bit of both, really, which was really interesting.
Yeah, great. No, we might come back to the kind of opportunities and threats from AI maybe a bit later in this discussion, hopefully. But Jim, could you maybe just to frame the discussion, could you maybe just provide a bit of a summary of those kind of common characteristics that the team at HG are looking for within that portfolio? Because there is a kind of type of business which kind of typifies that strategy. Can you maybe talk us through what the team are looking for when they're looking for investments?
Yeah, so it's pretty narrowly focused. So effectively, we look for investments in a number of clusters. So there's 8 clusters, and they're all sort of defined by B2B software and services businesses that fit the cluster definitions. And what they are, we call them resilient, but what does that really mean? It means that they have really high recurring revenues. So there's sort of 96% plus recurring revenue. And that is an amazing thing. And it's a relative, like a consulting business, your recurring revenue is 0 one year to the next. And these businesses is 90% So there's a sort of a highly resilient, they are tools that automate workflows that make companies more efficient in areas where it's actually they're sort of business critical services like tax and accounting. You can't not have it. And then because of the nature of the business model, the fact that you have this sort of very high recurring revenue rate, is just a great place to build from. And that's the sort of the high level structure. So it's B2B services and software, business critical workflows in 8 different clusters in Europe and North America. And that's basically it. That's us in a nutshell.
And it tends to be kind of accounting, payroll, legal, and insurance. They're kind of very common kind of hunting grounds, I guess, for the team. Very kind of typical areas. could I ask you maybe just to dive a little bit deeper into, maybe give us a couple of examples of holdings and then maybe the investment case behind each of those, maybe pick one or two of those areas, kind of key holdings at the moment?
Well, the last thing we've done is this thing called Audit Board, which is accounting software in the US. And it is all based around what's called Sarbanes-Oxley compliance, which I now know a lot about and I previously knew nothing about. So and it's basically rules and regs in the States that companies have to comply with. And actually it's a complicated workflow. So it's a complicated workflow that particularly for internal audit, you need to go through to be able to sort of beat the rules and regs. And Audit Board is a business that was founded by a bunch of internal audit professionals to solve this workflow problem. And the idea behind that is that it rhymes. It's very much in the middle of the fairway from a sort of a cluster perspective because we've got a bunch of accounting stuff that we've got in other portfolio companies. And it fits that site pattern of business with very significant installed customer base, very high recurring revenues. But in this world, that the opportunity to sort of go from paper and pencil to technology solution is at the very, very beginnings of what it could turn into. So the idea is to sort of take this platform and just organically grow it over a period of time and reach scale and build scale. That's a good one. Other ones, I mean, IFS is another one, and one of the tools there is that this is another asset which sits in the framework of what a CFO would need. So one of the pieces around the CFO's role is there's sort of multiple different things that you have to have. You have to have tax and accounting, you have to have tax compliance, you have to have treasury function. And the idea behind the office of the CFO is to sort of continually automate the workflows and to integrate the workflows. And IFS is another good example of that. And that's a Saturn III investment, as is Audit Board. So these are just a couple of more recent ones that are fitting that sideline. And but also the other thing around it is it's not like HG spends time looking at stuff that doesn't fit the sideline. It just doesn't. So anything that doesn't fit that pattern of what we're expecting to do, or what we've done in the past, means success, which doesn't happen. To the extent the team just doesn't even look, there's no point. So that's how we do things.
Jim, can you maybe just briefly talk us through kind of how the kind of typical type of deal that HG does? I mean, in terms of kind of ownership stake, kind of how active you are with the operations of a business or the direction of travel of a business. Can you maybe just briefly talk us through that?
Yeah, so most of the time it's control, or it's structured as control, even if it's not 51 of ownership. And I'd say the other thing around it is that because the HG's been doing this for a while, actually, it's amazing how it almost turns on itself to the extent that people come looking for HG rather than HG going out to look for people, because they look at the history of things like Bisma, which has been around for 18 years in the portfolio. And they go, actually, we'd like to do what they did. So there's and examples of businesses like Howden, which is a big investment in Saturn. The way the model of interaction actually supports the deal happening in the first place. And then in terms of the model, I mean, so step zero is that the businesses all have this pattern of characteristics which HG thinks is attractive, or else they wouldn't start. And then in terms of the engagement going forward, I mean, there's a lot that happens. So there's a team of about 60 people that run around helping these businesses doing different things. And there's effectively a sort of the way I call it, there's a sort of group that looks for what is the organic full potential of these businesses. And that is things like product market optimization. So do you have the right products to sell to the right customers? Do you have the right pricing tools to understand how to bundle your products effectively to optimize the value that you can create? And then we try to look for things in fragmented verticals. So Audit Board's a good example where, there's lots of smaller businesses that you could actually build scale from tacking them onto a bigger platform and integrating them. And, Bisma's done hundreds of M&A transactions, which is another lever. So what we typically see is when that team gets going, working with management teams, it normally gets about, say we get 25% EBITDA, it gets about half of it organically, which is a piece of value optimization around pricing for products, and then a piece of customer wallet, which is selling more things to the same customer. And then you add, and M&A is the other half, and M&A just accretes to that and gets you to 25. But there's a big group. I mean, it's probably got, on a sort of a relativity basis, it's got more people running around in the portfolio team versus the investment team of just about any private equity firm.
Yeah, lots of resources there. No, thank you for that. So the software sector, we kind of mentioned the kind of AI piece, and then kind of the work that you're doing there, kind of taking yourself back to school, being perhaps one of them. But the software sector has brought a kind of high level of disruption to many areas, but it's kind of not immune itself from disruption as well. So I wonder if you can maybe talk us through some of the things that the team are considering in terms of kind of potential threats from technological developments such as AI or others, and also that kind of challenge from the kind of large incumbent players potentially playing in some of these areas, some of these sectors. Could you maybe talk us through kind of some of the things that you think about there?
Yeah, well, we worry about it a lot as a board, right? So if you look at the risk register, it's sort of one of the things that's right up there is how do we not get caught out by this? And that's why one of the reasons I took myself off to Stanford was to try and find out about it. What's really heartening is HG have figured this out as well. So, in terms of, it's always a bit, when we say we're a bit worried about AI, they go, really? You're a bit worried about AI, aren't you? I mean, it's like, what do you think we're worried about? So the good news for them is they've spent a lot of time and effort on this. There's a group that Amr runs inside of HG who spend a lot of time on it, and they're an OpenAI development partner. So, I heard about OpenAI when it got to GPT-4, and they've been working with them since GPT-2. So, they're trying to stay ahead of it and understand how they can take what it does and actually integrate it into what they have, so that their businesses build their relative competitive advantage rather than get caught out by it. And the other thing around it, when you do spend time looking at it in depth, as I did, is you realize that the way that the threat manifests, it's actually, for what we do, I think it's going to be more of an opportunity than a threat, because I mean, AI is pattern recognition effectively, and pattern recognition is driven by data, and more than anything else, and the businesses we've got have got a lot of data, so actually they're well placed to be able to take advantage of it. And if you come in from as a startup, then you just don't have that. So your ability to be really disruptive in our type of assets as an AI business is actually relatively low, but the technology is a real enabler of the existing businesses to get way more effective in what they do. And so that's why I kind of came in going, what am I going to find here? And came out going, you know what, we could be on the right side of this.
Yeah, lots of business desperately trying to find and sort all their own data first, and I guess these sorts of businesses help manage that before you can even think about kind of the application of AI. So you can definitely see how that makes sense. Jim, I wonder, we have to talk about valuations. I wonder if we could kind of talk through the kind of valuation of the portfolio at the moment, and obviously the realization of holdings at or even above book value. The strategy has been so successful at kind of executing that, and that kind of brings with it a lot of comfort to holding valuations. But could I ask you just to provide a bit of a comment on what aggregate valuations look like in the portfolio, perhaps against whether it's kind of listed comparables or other M&A transactions, kind of how you think about valuations?
Well, let me just explain how we do it. So I think there's 50, just on 50 assets in the portfolio. So 4 times a year, we go through this line by line, asset by asset. So each one has a basket of comparables, which is around about 15 line items, split between M&A comparables and publicly comparable peers. And so every time we look at the valuations, we're looking at all those M&A comparables for the deals that look broadly like what this particular asset is, and then the listed comparables that sort of broadly fit the sightline for that. And that is what goes into the basket, quote unquote. So effectively, every asset has a real basis in either that public comparable or the M&A. The weightings are adjusted so that when deals are more recently done, they're more weighted towards the M&A, and then within, I think it's 3 years, it goes to the public comparable. And actually, in the last valuation cycle, we accelerated some of the switching to say, actually, let's go to the publicly comparable valuation sooner. And that is how that multiple is really derived. And then it uses the EBITDA of the business, which is the adjusted EBITDA, which is the metric. And then we true up for the capital structure and then knock off the debt and then adjust for our ownership percentage and gets to the answer. So it's pretty robust. I mean, I've seen a lot of different valuation approaches over the years, and I'd struggle to think of what else we could really do on this. And then again, the numbers are pretty punchy. I agree with that as well. But the heartening thing is that we do still seem to have this record of being able to sell things above where we mark them, which I suppose is it should be that way, because I think the marks should be robust given the process. And when in private markets, when you sell something, you always sell next year. So if the business is growing and you're selling next year, then there should be some kind of uplift against wherever it is you're selling it, or else you just don't sell it.
Yeah, there's some important points in there. Thank you. Jim, you've obviously got a huge amount of experience in private equity in general, not just in your position at HG on the trust, but also several positions, both past and present. Can I ask you just for, I know it's a huge topic, but just a kind of broader outlook on the PE sector in general? I mean, we've obviously gone through this big challenge of what interest rates have done, the funding environment, and kind of that wave of capital that kind of came before it. But they're kind of brief things that you put out as kind of main points on PE in general at the moment.
So I'd say we're going through a bit of an indigestion period. I think particularly and HG has done really well at this, but others have had a much harder job of actually creating liquidity. So being able to validate the assets that they've got by liquidating them at something close to the values that they're holding them at. And that's a big theme right now, is how does the industry actually send money back to the investors? Because that's the cycle of life in private equity. If you don't send it back, it won't go back out again. And that's what you're seeing right now, is a real push to try and get that cycle to sort of operate again, or operate more effectively. Seems like it's a better half of the year. First half, there's more transaction activity, there's more stability, because effectively the thing that created a problem for the industry was the rate cycle moving so rapidly. Because private equity is totally fine at 5% interest rates, and it's totally fine at 1% interest rates. It's just not great in the middle. And what's happened now is the things have adjusted. So you've sort of seen the system solving. So you've seen businesses have to some extent grown into their valuations. There's more realism around what can be sold and what price can be sold for, and that's what's beginning to see the unlock. But there was that period when things got dislocated. There was a problem because nothing happened. The whole thing gummed up, and that's created this backlog, which businesses have to work through, and that's what you're seeing happening now. And the firms that are sort of best positioned are the ones that are going to sort of gain relative ranking in the industry, because they've been able to continue to operate through that tricky period, and that's been pretty powerful. It's been great for HG.
Yeah, that makes sense. Jimmy, a couple of quick last questions, if I may. One of them was on, obviously we talked about those kind of core sectors that you've been so, the trust's been so, HG's been so successful at kind of investing in. I wondered if there were any kind of new themes that the team were exploring that kind of equally had those kind of characteristics of really high, good recurring revenue, being kind of mission critical areas, but other areas where software or innovation is kind of maybe stretching into other areas of industry. Are there kind of other areas that the team are kind of looking at kind of underneath the kind of core holdings?
Yeah, the answer is sort of yes and no. So the no is they're the kind of profile of investment that HG targets isn't going to change. So they're not going to go down, because everything that we buy is sort of massively cash flow positive. So they tend to be very sort of mature, cash generative businesses of scale. So that, for the most part, very significantly, that's what we do. So they're not going to go down into fintech land, right? That's not really the way it's going to go. But within that, the current cluster definition, the other thing around it is for to get, because basically HG basis runs on a flywheel. So the flywheel has to spin to really get the benefit of the accumulated knowledge and experience. So it has to be big, or else it can't spin. So the lens that they look through is like, where could we find those same characteristics of very high recurring revenue, business critical services, B2B, solving workflow problems, and at scale. So where there's a big opportunity. And the answer to that is, there's nothing obvious. I mean, it's not as if they're about to head off into tourism and leisure. I mean, that's just not there. But what does happen, and again, I mentioned it earlier, within the existing areas, there are more and more workflows that you can automate. So, and this is they get the IFS one, which is all about the Office of the CFO. That's a new thing. So Office of the CFO is about a 2-year-old strategy, where effectively you start to see business like G Treasury and IFS, which are all in the same rhyming pattern of how do you go after a CFO's budget effectively, and how do you sort of help them become more efficient with the workflows that they've got to manage with the CFO role, and buy products that slot into, or build products that slot into their needs. And that's a good example of the latest one. So I think what you'll find is, rather than a 9th cluster, which I think don't see where it comes from, I think what you'll see is just more and more stratification within the existing ones as they develop new verticals where the toolkit applies equally as well as it does on the others. And this Office of the CFO thing is the sort of latest, greatest version of that.
Yeah, that makes sense. Yeah, thank you. Jim, our final question is another standard one that we've asked all of our kind of speakers. It's one that asks what their kind of highest conviction area is at the moment, and I'm not necessarily asking you to pick the favourite thing in the current HGT portfolio, but I wondered if there was a kind of specific area or subsector or specific area that you kind of highlight as being over a certain time period being particularly positive on.
Yeah, well, we love all our children, so that's one thing. I mean, on the different areas, I mean, I'd say, that there's still loads to go for on tax and accounting and ERP. And you've got, I mean, we still think like businesses like P&I in the Saturn portfolio, still Visma, which is still going incredibly well, even at scale, will continue to be big drivers. We think Howden, which is an insurance-related business, will also be a big driver. And those are the big needle movers, because those are the biggest businesses in the biggest checks investments in the fund. So they're the fact that the multiple of capital that they will accrete to is high, but also the amount of capital that goes in is high. It means they're very impactful for the outcome. And then down at the other end of the spectrum, obviously, which is Mercury, is a much smaller business, but indeed very high potential. And then in the middle, Genesis, businesses like Septeo and Gen2 are also looking really, really good. And they all, the HG is always sort of looking at the different entities and going, where are the breakouts, and where could things, we had that understanding of what we thought we were going to get out of this when we went into it, and where are we going to exceed those expectations, and these are some of the assets where we think we're going to exceed them. So it's across different sectors and verticals, but there's a sort of a bunch that look like they're really well positioned.
Yeah, great. Yeah, no, thank you for that, Jim. Really nice to talk to you. Thank you for your time. Appreciate that.
No problem. It's a pleasure. Thanks very much for having me.
Thank you for listening to the Investor Insights podcast, hosted by Killik Co. You can get in contact using our podcast email address, investorinsights@killik.com, for more information on any of the topics discussed, or for further details on the services offered by Killik Co. This podcast is not personal advice. The content is intended for educational purposes only and is not investment research or a recommendation to buy or sell any financial instrument or product, or to adopt any investment strategy. The value of your investments can rise as well as fall, and you could get back less than you invested. Past performance is not a guide to future performance. The investments referred to in this podcast may not be suitable for all investors, and you should seek advice from a qualified investment advisor. Killik Co is authorised and regulated by the Financial Conduct Authority, the FCA.